So speaking a little bit about economic indicators, so the definition of an economic indicator is any statistic that reflects the economy. So these statistics can be published by the government, derived by analysts, or even by private companies, and they can be released at various time intervals. So some common economic indicators that are usually used by people to judge the health of an economy are the consumer price index, CPI, gross domestic product, GDP, employment figures, and the price of crude oil have all been used to sort of assess the health of the economy at different periods of time. So there's three types of indicators, which are coincident, lagging, and economic indicators that sort of predict the future. So coincident indicators, which include things such as GDP, employment levels, and retail sales, are often seen as, at that time, how was the economy doing? So this shows the economic activity at a specific point in time currently. So it's very current. It's kind of up to date. Lagging indicators such as gross national product, CNP, unemployment rates, and interest rates are often seen as lagging, which means after the economy goes through a sudden change and whatnot, those indicators these economic indicators reflect the change sort of later. So that's the way to sort of judge some of these economic indicators.
Okay, so let's start out with the gross domestic product, which is the GDP. The GDP is the total value of all of the goods and services in a specific political region. So that can be a country or a state or even a city, and that's how it's measured, and it's measured through every calendar year. Gross domestic product is really responsible for giving us economic indicators on how the Federal Reserve uh, adjusts their policy and interest rates. So basically, the Federal Reserve is responsible for keeping us away from a recession, and they do this by looking at the GDP and then adjusting their rates accordingly. So the equation for the GDP is consumption. So consumption is basically the total value of the goods and services that corporations and consumers in a certain nation or in a certain political region, that's how much they spend. So consumption could just be defined as consumer and corporate spending, and it's the total value of all of that. Secondly, we have the gross investments. Gross investments are the measure of physical investment, the value of all physical assets and capital invested, and that's just used to calculate the GDP, and it's basically the value of all of the money and physical assets that are in a specific political entity. And then the third thing that we're going to use is the government spending. Government spending, it's in the name, it's just how much money our government uses every year. And then the last thing are exports minus imports. Exports, of course, being the value of all goods and services sent from our country to another country. And the imports are from another country to our country. When GDP increases, it basically means there's a higher demand for consumption, there's higher demand, higher supply, and then the supply and demand basically entitles a higher overall stimulated economy. And it's just correlated with the growth of companies and the growth of stocks as well. A recession is used to define as in a fall in GDP in over 2 successive quarters, but that was the old definition. We've started to move away from that, and later we'll get into why that's not an accurate indicator of GDP and of the overall economy. Um, so just getting into exports and imports, there's two types of categories that a country can fall into. They can fall into a trade surplus or a trade deficit. A trade surplus is when the country is exporting more goods and services in total value than they import. And a trade deficit is when they're importing more than they're exporting. Can anyone name an example of a country that's importing more than they're exporting? So that would be a trade surplus. You can just say it out loud.
America.
America is actually the opposite. The United States is in a trade deficit, meaning they're actually importing more than they're exporting. Yeah, he said China, and they are exporting more than they're importing. They have a huge total capacity. Italy, of course, a lot of EU countries are specialized in manufacturing luxury goods, so they do a lot of exporting there too. And so just to just to build off of that, the United States trade war is based off of how the United States is in a trade deficit. So we are really importing a lot more than we're exporting, while China is having a trade surplus, meaning they're exporting a lot more than they're importing. Can anyone tell me why a trade surplus is a better thing than a trade deficit? You can just say it out loud.
They have many resources since they're importing.
So the trade surplus is when they're exporting more than they're importing.
Oh,
So why
sorry,
is
never mind. So then that would result in more money. So basically profits, which would uh, help the economy.
That's exactly correct. In the trade surplus, the company or a country manufactures a lot more of their own stuff, and they're much more self-sufficient, and they actually make enough excess product and enough excess services to be able to export the extra stuff to other countries and make a profit. So that's exactly correct. So just moving on from that, we have I think we have a graph at the United States economic growth in the past 20 years. So just looking at this graph, we see that there is from around 2000 to 2008, it's looking like the overall economic growth is starting to slow down a lot, but it's not necessarily in the negatives yet, and uh, we don't hit that definition of recession, which is at that time the definition of recession was when the overall GDP went down. It goes down for two successive quarters. So we don't hit that until 2008, which is during the Great Recession. But the reason why we no longer use the 2 quarter measurement as a recession is because it's just not an accurate indicator, and that's because despite the uh, the drop in economic growth, we didn't actually officially say that it was a recession until over 8 months of there being a recession. Why is that? That's because the overall economic growth slowed down, but it never fully went down, or it was never calculated as such, just because there's a lot of zigzagging, as you can see. There's a lot of staggered growth, where we can see that the growth definitely does slow down, but it doesn't hit that negative until around 2008. So we try to move away from just using GDP as an indicator of economic growth, and nowadays we try to use other factors. We use employment rates. We use the amount of labor force that's unemployed. We talk about the overall consumer spending, which is part of the GDP though. And then we also have human capital. So that's like uh, the the value of a certain labor in their corporation, their intrinsic value of a person essentially. And we try to use these different indicators to create a more holistic approach in calculating the economic growth of a country. So we no longer use just the 2 quarters in a row of, econ, of economic drop as GDP anymore. So we're trying to move away from that. And then next we're comparing California's GDP to the
Before
United
that,
States.
Gordon,
Yeah.
let me say one thing. So Gordon did mention a couple indicators just now, which shows us that, like college apps, which is on some of our minds, they really try to take a more holistic view of what's going on with the economy instead of just saying, oh, 2 quarters of GDP down, that means we're in a recession. There's like many more factors that go into that. But one factor that I would really like to focus on is the very first one that Gordon mentioned. Does anyone remember it? It's okay to be wrong. Okay. Well, basically, it was job loss. And that's like a really important factor to take into account, especially like now, obviously. But also in 2001, because Gordon's example is 2008. But with both of the recessions, job loss was still an important thing to take into account. And especially with 2001, the GDP was actually not that bad. It was zigzagging a lot, as Gordon said, but it wasn't plummeting. But the job loss kind of was. It was the main concern for 2001. So if you took one factor, if you really had to look at one factor and take a really simplistic view, I would say job loss would be a better one to take than GDP. Yeah.
Also, another thing to add, the Yelp review site has been tracking announcements of business closings posted on its site. So they listed that there were 132,000, I believe, businesses that remain closed as of July 10. So that's another. So other private companies can also release some factors, economic factors.
Yeah, that's a really good point. That we look at all these factors that are government released, like you see at the bottom and stuff like that, organizations or whatever. But companies also affect the general sentiment, market sentiment over things like this. So yeah, moving on.
So we're just going to go through the comparison of the GDP of the United States and California. So comparing California to the United States, historically, California has heavily outperformed the United States in terms of economic growth. And that's just because of their reliance on one industry in particular. If anyone can just say what industry really succeeds in California. Exactly. Matthews, I think he said technology, and it is technology is the biggest industry in California, and technology in the United States as a whole is very it essentially carries the economy. But in California, where there's such a high concentration of these big tech companies, Silicon Valley, there's a lot of room for economic growth, especially if we compare it to the rest of the United States, where a lot of older industries, steel, I think coal, and a couple of corn and maize, and like the growing of crops in the Midwest, those industries have really been overshadowed by the performance of the tech industry in California. And that's just why California's overall economic growth just is much higher than the United States. Cassie, do you have anything to add?
No, I think you covered it really well. But I guess one thing to note is that obviously California's GDP is more volatile. It does fluctuate much more than the US, I guess, because there's a lot more factors to take into consideration with the US. And so overall, they're kind of following kind of the same trend, which is to say mostly flat. But they kind of coalesce around the same value. But Gordon's right with the fact that California is still outperforming the US GDP. Okay, back to the presentation.
So seniors, if you're currently taking AP Macro, or if you guys will be taking it at some point in high school, you will eventually learn about money supply, which refers to the total amount of currency and other liquid financial products in an economy at a particular time. So there are actually several measures of money supply depending on what is in. I think someone's echoing real quick. You can call me. So the basic rundown is that M0 includes only hard currency in circulation. M1 includes all of M0 plus checking accounts and certain other checkable deposits. And although checking accounts are technically out of circulation, the owner can retrieve that money from the bank upon demand. M2 includes all of M1 plus liquid deposits that can be converted within 30 days. And M3 includes all of M2 plus investments that cannot be converted to cash within 30 days. So as of June 2020, the Federal Reserve announced that there is a little over $5.2 trillion in M1 money, like I said, which is the hard currency, and more than $18.1 trillion in M2 money in circulation. Now, you may be confused of what I just said because I'm using the term liquidity. Now, the basic definition of liquidity is the feasibility of which an asset can be converted into cash. So if we visualize a spectrum of liquidity and we have two polar ends, on one polar end, we have the most liquid, being cash, because it doesn't require any prerequisites into converting it because it's already cash. And you can use that cash to buy goods and services and pay off debt and whatever. On the other end, can somebody give me an example of an illiquid asset? And it's okay if you're wrong. I don't care.
A stock or
Real estate?
some investment?
Josh, who said real estate?
I did.
Who's I?
Karan.
Karan. Karen. Okay, sorry.
Yeah.
Karan and Josh, you're both correct. That's like spot on. So real estate is very illiquid because not only is it really hard to sell off a home like ASAP, you know, you have to go through your due diligence, you have to actually list it on the market. The intrinsic value of a home won't be exactly the same as the paper value. So the paper value can be like overvalued or undervalued compared to that of its intrinsic value. So hopefully you guys get the basic idea of what liquidity is. And moving on, when we talk about money supply, it's essential to talk about who controls it. The U.S. actually has a central bank, like we mentioned, I think Gordon did, called the Federal Reserve, also known as the Fed, which is arguably the most powerful institution in the United States, if not, I mean, the United States and nationally. Because it can legally U.S. Treasury and their securities from banks and replace them with credit, which is basically like printing money, quote unquote. So the goal of the Federal Reserve is to maximize employment and keep inflation stable through monetary policy. If you guys are taking notes right now, monetary policy is an important term to know. They also regulate commercial banks by assessing their health, ability to manage risk, and compliance with consumer protection laws. I know I mentioned this way too much, but if you take the financial markets course by Robert Shiller, he goes in depth about the Fed's stress testing and such. And one of the chief responsibilities set out in the Fed's charter is management of the total outstanding supply of US dollars. So the Fed is responsible for creating or destroying billions of dollars every day. Moving on, try to visualize the economy as a falling row of dominoes. The Fed will be the first domino that sets a chain reaction through its monetary policy. As you can see on the slide, more money makes more spending, which creates a positive outlook on the economy. But there are many chains of reactions with money supply. And I could talk about monetary policy all day, but the fundamental thing you need to know is that it smooths the ups and downs of the economy. And in times of crisis, like now, the Fed can pump emergency cash, slash interest rates, etc. Recently in August, the Fed announced it would allow inflation to rise above its 2% target for a period of time. This would help spur consumption and give the Fed more breathing room to handle future downturns. Cassie, do you have anything to add?
Oh, I think we basically covered everything. Okay, moving on.
All right, so I know many of you guys are 16 or will turn 16 soon and you'll get your first job. So this is gonna be really important for you guys to understand. So we're gonna talk about employment, unemployment, and labor. So first, let's actually define the unemployment rate. So how we do it is we divide the amount of people who are out of a job but actively looking for one by the total labor force, which includes people who are working, the people who are looking for a job, people transitioning between jobs, etc. There are three types of employment: structural, cyclical, and frictional. So cyclical is when there isn't enough aggregate demand in the economy to provide jobs for everyone. Or in other words, because there's less demand, less production is needed, and thus fewer workers are needed. Structural basically occurs when the labor market isn't able to provide jobs for everyone who wants to work. Think of it as the skill levels aren't matching, or they're just simply not enough jobs. And frictional is similar to structural, and it's pretty much defined as when a worker is seeking a job or transitioning from one job to another. The important thing about frictional is that it's always going to be present in the economy. So before we go even further, does anyone, without searching it up, want to guess what the current unemployment rate is in September? Any guess works. Just take a swing at it. There's no harm in doing so. All right, 6%, 9%, 8%. No, yeah, those are really good guesses. 9%, yeah. 9. Cassie, if you click on the slide, I think it shows the actual number.
Before I show it though, does anyone know whether it recently decreased or increased?
Oh, yeah. Yep, that,
We have a lot of people who are caught up in current events. Okay.
right. So as of September, the unofficial unemployment rate was at 8.4%. So now adding on to unemployment. Oh, by the way, great guesses, everyone, on the unemployment rate and whether or not increasing or decreasing. Anyway, so now you may think that zero unemployment is good, but obviously it's not good for the economy. Actually, not obviously, but it's not good for the economy. Does anyone want to take a guess why?
I guess there's no new people that could be hired. I don't know.
It's good reasoning. Anyone else? Less money in circulation. No one spends. Does that mean people are inefficient? Cost of labor increase? No work, no money made to be spent. Yeah, these are all great guesses because they work too slow, less work per person, so less productivity. Yeah. Slow progress. Yeah, these are great guesses, guys. But basically, why it's not a good idea is because there's really no room for companies to grow. And why that is because, well, for one thing, this isn't possible. Zero unemployment. It's not possible in the real world because, as I mentioned earlier, there's always going to be frictional unemployment, right? People transitioning between jobs or looking for it. But the basic idea is that in order to allure workers in the limited labor forces, companies pretty much jack up their wages in order, to get people to work, which in turn, or to work at their company, which in turn leads to inflation, which, as you guys know, a lot of inflation is not good. And the relationship to describe the relationship between, or the idea to describe the relationship between inflation and unemployment is called the Phillips curve, which, as many of you may know, is not true in the long term. Phillips curve, by the way, pretty much says unemployment and inflation are inversely correlated. So when one goes up, the other goes down, and when one goes down, the other goes up. And that's basically, it does hold true in the short term in some situations, but in the long term, it's not true. So anyways, why were we even talking about this? As Gordon mentioned earlier, we took a holistic review when assessing the economy and using economic indicators. And as you mentioned, unemployment is pretty much one of the main ones we look at. And if you're wondering why that is, it's because lower unemployment means more people with jobs, which means more money for people to spend, more consumption, more economic outputs. Think of it as like a positive reinforcement cycle for the economy. It's pretty much like a bull market. If you think back to the first boot camp we held. Yeah. So taking a look at these two graphs here, we can see on the left that the weekly unemployment claims in 2020 were pretty stagnant from February until March, up until the pandemic, where we see a huge increase to, I think, very high at 6.87 million in the first week of April. By the way, April had one of the highest unemployment rates ever since the Great Depression at 14.7%. But as you can see, the unemployment rate has gone down in accordance to unemployment claims also going down over time, but we're still at a very high amount at 1.3 in July when this was last reported. Now, if we took a look at the graph on the right, we can see that over the last 50 years, around 0.25 to 0.75 million people filed for unemployment benefits on average. And this year, as you can see, there's a vertical increase up to 3.28 million. So unemployment this year has gone really historically bad. And as you guys know, that's obviously due to the coronavirus pandemic and shelter-in-place restrictions. So one thing I want to really emphasize, or before we move on to interest rates, I want to really emphasize that the way we calculate unemployment is flawed and it can be pretty misleading sometimes. So this is a really good quote. The shrinking labor force is the primary factor behind the unexpected decline in the unemployment rate. Or in layman's terms, what we like to say is the unemployment rate fell for the wrong reason. If we look at this year, for example, although the amount of workers who have been temporarily laid off have declined, the amount of workers who have lost their jobs permanently have swelled, contributing to a much riskier period of joblessness in which it becomes much more difficult to find a job when unemployment stretches over a long period of time, which is now, by the way. And it can be really hard given our job market at the current moment. Other reasons why is that, this is a general macro trend, by the way, in the last couple of years, is that the retirement of baby boomers, whose ranks are dwindling faster than the number of young people entering the labor force, effectively decreases the labor force a lot. And slower economic growth in the year have also discouraged people for looking for jobs. So if there are less people looking for jobs, that means unemployment rate is actually going to fall. Because remember, we calculate unemployment by finding the amount of people who are willing to work or who are out of a job and looking to work divided by the amount of labor force. So if there are less people looking to work, then the unemployment rate will fall. Same idea goes for something called discouraged workers. These are people who don't have a job but aren't actively looking for a job. During the pandemic, a lot of people really became discouraged workers and completely fell out of the labor market. So as you can imagine, the unemployment rate has gone down in accordance with that as well. So basically the main idea here is to really take a look at unemployment and what's really happening, because sometimes it can be extremely misleading.
All right. Okay. Okay, so interest rates. The definition of an interest rate is basically the amount of money a lender charges for borrowing money. And this is expressed as a percentage of the principal, which is the original amount of money you loaned. So put simply, this is the cost to use someone else's money. So for example, if you loaned $10,000, which is the principal from the bank, and they had a 10% interest rate, it would cost you another $1,000 per year. So the most important interest rate is the federal funds rate, which is the interest that the Federal Reserve charges, which Matthew said before, is the central bank of the US. And they control inflation, which is the rate of which prices of certain goods or services increase over time. And they do this by increasing or decreasing interest rates. So if interest rates are lower, people take out more loans because it's cheaper to do so. And if there's more money in circulation, the value of the dollar goes down. And as a result, inflation, spending, and stocks increase. On the other side, if interest rates are higher, people won't take out so many loans, and there's less money in circulation, and inflation, spending, and stocks decrease. So, question for the audience. Because of coronavirus, do you think the Fed increased or decreased interest rates? And as a hint, increasing rates makes money harder to get, and decreasing rates makes it easier to get. Yeah, so everyone's saying decrease in the chat. So there's less spending because businesses are shut down, people stay at home. So the Fed would lower interest rates to encourage people to take out loans. Okay, so trade and tariffs. So a tariff is a tax on goods entering the country as an import. And this almost always increases the prices of imported goods since the cost of production increases because of the tax. And a question for the audience again. How do tariffs increase production in the country it's enacted in? So a hint is if you own a company, you want to make the most amount of money possible. Yeah, you got that right. So basically, if there's a tax on goods, it would be cheaper to produce the product in the country instead of importing it. So that increases production within the country that set the, which is producing it. And this protects domestic industries. So countries can respond with tariffs with retaliatory tariffs. So for an example, let's say country A sets a tariff and less companies import goods from country B since it's expensive to. This hurts country B because it's harder to profit, so they retaliate this with a retaliatory tariff. Now country B imports goods less because it's expensive for them, which in turn hurts country A's exports. So this can also have varying effects in the market since many products can become more expensive or some companies can become more profitable. And sometimes in a domestically operating company, which is a company that handles its activity and affairs within the country, they have less imports, so tariffs don't apply as much to them, and their stocks increase as a result of their profits. Also, tariffs can hurt companies who import their goods, since importing goods becomes expensive, and the company will make less money as a result. So they increase the price of their goods, and people don't buy it as much.
All right. Okay. So signal and noise. These are two concepts that are a little less talked about in intro to econ. Although they're still important, but they're kind of like killjoys because they're why you shouldn't always pay attention to economic indicators. And if you're in Matt and my group for mentors groups, one we'll do later on, we focus a lot on econ and behavioral econ, stuff like that. So this is definitely falling under that category. So with signal and noise, what's important to remember is that not everything that you see in the market literally means something. Not everything is significant. Because, you know, people make mistakes because the market corrects itself because there's a lot of things that go on that aren't really explicable. There's a lot of things that are just based off of pure feeling and sentiment. And they're just kind of like what's popular or what a lot of people think. Then people start bandwagoning. And then there's this whole weird movement that goes on and it corrects itself over time. So the basic definition of noise is information or an activity that misrepresents or distorts a trend. So that can mean that there's a trend that was happening and maybe it exaggerated it, or maybe it interpreted it wrong, or maybe it actually changed the trend itself. It just depends. Some causes are program trading, which is when you basically use like a computer programming, like kind of like an algorithm to buy a whole bunch of stocks in a very short amount of time. There's also dividend payments, which if you guys remember, it's basically when companies want their investors to stay loyal to them, so they give them some regular cash installments. So the effect of noise is that you have short-term volatility, right? So stocks fluctuate a lot, prices move, and corrections, which is basically when a stock will basically correct itself. So usually that means that a stock that is overvalued, right? Overvalued means that everyone thinks that the stock is worth this much, but in reality, its intrinsic value is only this much. So the correction means it's basically decreasing, right? It's overrated, so it's decreasing. So a correction is around 10% or more of a decrease, so it's pretty substantial. Okay, so the important thing to do with noise is that it's hearsay and it's reactionary. It's not really based on fundamental analysis. It's kind of like the gossip of the economic world. Okay, and then in the short term, it's really hard to distinguish information from noise, right? Because it's hard to distinguish whether everyone making a move in the market is a good idea or not. In the long term, well, hindsight is 2020. I know that's a joke because it's 2020, but still, long term is always a good idea to consider what has happened instead of just kind of acting in the heat of the moment, unless I guess you have a really good reason to do that. And the signal to noise ratio is basically useful info divided by irrelevant data, right? So if you have a lot of useful info, that means it's a high ratio, which is little noise, which is good. And then a low ratio means you have a lot of irrelevant data, which is obviously not good. Yeah, so overall, indicators kind of sometimes take it with a grain of salt, sometimes they're important. So I basically chose to just take a look at Tesla. So the first graph that you'll see on the front of the page is a single day of Tesla stocks. I think I just took the screenshot like yesterday or something, or 2 days ago. Anyway, so you'll see that Tesla's like in the red, it's going down, declining, right? It's not that big a deal, but it's still making substantial movement for one single day. And so you might decide to sell, or maybe you don't. And even if you look at something for a couple months, like a stock market game will take, you might still get the pattern wrong, right? It'll still keep going down. But if you look at it over a couple of years, you'll see that Tesla was extremely profitable if you invested in the very beginning. I'm not telling you to go invest in Tesla. Some people did last year. I don't actually know how they ended up in the game. Matt, I guess if you remember, you can pitch in. But yeah, Tesla, risky stock, but you should take a look at those if you want. Okay, so before Matt announces the SMG game, a little pep talk. A lot of people don't like to invest because they think it's too risky, right? But I think risk comes reward, right? So if there's risk, you also have tools to take informed risk. First of all, you diversify your portfolio, and hopefully you guys know what that means by now. But it's basically finding a whole bunch of stocks and securities, including bonds and funds from different sources, different industries, and diversifying your portfolio so that the risks cancel each other out. Also conduct your research, fundamental and technical, and be patient because stocks change a lot in a day, even a week, even a month, even several months, but eventually you'll see a trend and make a good decision. Okay, with the remaining time, sorry, Matt and Colleen, I didn't give you guys much time to keep going. If you want, we can rejoin the meeting, but I guess, Matt, you can get started.
Okay, so I'll keep it brief. The stock market game. After our boot camp sessions, we always hold this annual stock market game, and it's on Market Watch. Essentially, what it is that you're going to be teaming with other people, up to 3. You can work by yourself or with another partner or 2, to invest $100,000 into securities. So this is like stocks or bonds, and your goal is to try to invest a certain amount of risk for a certain amount of output, where you can get the most money return. With that in mind, it is a competition. So if you earn the first place spot, you will earn the first place prize, which is a $50 Amazon gift card. So hopefully that provides some incentive for you guys. And I guess the only tip for me is to don't put all of your eggs in one basket. Don't invest $100,000 into Tesla. Try to keep it diversified. And the point of this game is to use what you've learned from boot camp and use the technical and fundamental analysis into influencing your decision on this game. And hopefully you guys will do well in this game. I am excited to see how you guys perform.
And a quick note about that is that in the past, we kind of just like released you guys to the hounds in October, or released the hounds in October. And then we kind of like caught up in April. But then I think what was better this year would be to not forget about it, not get bored about it after a couple months. Instead, we're actually going to incorporate projects and fun activities to go along with the game, such as presenting your portfolio. We'll have creativity competitions with who maybe can buy creative stocks and actually justify them in a creative way, or maybe a good way. And we'll also have prizes for those as well. Okay, Colleen, would you like me to restart the meeting? Because Gordon has something to say about GDP as well. Okay, everyone. So if you can, please rejoin the link. And we only have like 5 more minutes of talking at you guys. So please do that. Thank you.